Have you ever wondered how a big company keeps track of every single dollar? Well, it is not magic. It is a system. This system is called the accounting cycle. Think of it as the rulebook for a company's money story. It ensures every transaction from buying a single pen to making a massive sale is recorded correctly. This process is the bedrock of financial clarity. It builds trust with owners, with banks, with investors, and even the government. Without this cycle, a business's financial world would be messy, confusing, untrustworthy, making it impossible to know if it is truly succeeding or failing. The accounting cycle unfolds in 9 distinct steps, each one building logically on the last. The first step is to identify transactions. This is where you recognize any business event that has a financial impact: a sale, a purchase, paying a bill, receiving a payment. The second step is to record transactions in a journal. This is the first official entry into the accounting system, done chronologically. Step 3 involves posting to the general ledger. Entries are sorted from the journal into individual accounts. This groups transactions that affect a single account, like cash, sales revenue. After transactions are sorted, the fourth step is to prepare an unadjusted trial balance. This is a list of all accounts and their balances. The total of all debit balances must equal the total of all credit balances, providing a first check for accuracy. Step 5 is to make adjusting entries, done at the end of an accounting period, to record revenues that have been earned, expenses that have been incurred but not yet recorded. The sixth step is to prepare an adjusted trial balance, a second trial balance created after the adjusting entries are posted, confirming the debits still equal credits. Every accounting entry begins with proof. This proof is called a source document. It is the original paper or digital record that contains the essential details of a financial transaction. Without a source document, a transaction is just a claim. With one, it becomes a verifiable fact. These documents start the audit trail. They provide objective evidence the event occurred. They answer who, what, when, where, how much. For an accountant, a source document is raw material to build the business's financial picture. Key types: sales invoice, purchase receipt, bank statement. Sales invoice: when you sell on credit, you issue an invoice detailing what was sold, quantity. Once a transaction is verified by a source document, its next stop is the general journal. Often called the book of first entry, the journal is where transactions are formally recorded for the first time in chronological order. Think of it as a financial diary for the business. Each entry tells a small story. On this date, this event happened, affecting these specific accounts in this specific way. Recording every transaction here first creates a complete and sequential history of all financial activities. This chronological record is incredibly useful for tracking down information about a specific event, understanding the sequence of business activities over time. A proper journal entry has a clear and consistent format. It always begins with the date of the transaction. Next, you identify the accounts affected. The account that is debited is always listed first, flush with the left margin. The account that is credited is listed on the line below and is slightly indented. This visual separation makes the entry easy to read. In the next columns, you enter the corresponding monetary amounts in the debit and credit columns. For every single journal entry, the total amount debited must equal the total amount credited, keeping the fundamental accounting equation in balance. To illustrate, let's look at a simple example. The journey from a single source document to a full set of financial statements is the essence of the accounting cycle. The journal and its supporting documents are the foundational pillars upon which everything else is built. They are the raw data and the initial record, capturing the financial pulse of the business moment by moment. Without accurate journaling and diligent document management, posting to the ledger, preparing trial balances, making adjustments, would be based on flawed information. This would inevitably lead to financial statements that are misleading, making them useless for decision-making and dangerous for reporting. Think of the entire process as a production line. The source documents are the raw materials. The journal is the first stage of processing, where these materials are shaped and recorded. The ledger then sorts these processed parts into organized bins. The trial balances are quality control checks along the way. Finally, the financial statements are the finished product, ready to be presented to stakeholders. Your journey to financial clarity starts now. Like, subscribe, and download the free accounting cycle checklist linked below.